90% of people who enter the stock market believe they are going to be the exception. They believe they will be the ones who buy low, sell high, and walk away rich. And yet, year after year, study after study, the data tells a completely different story. Most retail investors underperform the market. Many lose money outright. Some lose so much they never invest again. So the real question isn't whether people lose money in the stock market. They do, constantly. The real question is why. And once you understand why, you will already be ahead of almost everyone else who ever opens a trading app. Let's start with the first and biggest reason: emotion. The stock market is not actually a numbers game at its core. It's a psychology game that happens to be measured in numbers. Every single day, prices move not because companies suddenly become more or less valuable, but because millions of people feel fear, greed, hope, and panic, all at the same time. And human beings are biologically terrible at controlling those emotions when money is involved. Here's what that looks like in real life. A stock goes up 10% in a week. You see it trending, you see people talking about it, you feel like you're missing out on free money. So you buy in, near the top, driven purely by excitement. This is called fear of missing out, and it is one of the most consistent wealth destroyers in investing history. People don't buy because they've done research. They buy because they're afraid of being left behind. And by the time the average person hears about a stock everywhere, the smart money has usually already made its profit and is looking for someone to sell to. Then comes the opposite emotion: panic. The market drops 5, 10, 15%. Headlines scream about a crash. Your account balance turns red. And your brain, which evolved to protect you from physical danger, treats this financial threat the exact same way it would treat a predator. It screams at you to run. So you sell. You lock in your losses at the worst possible moment just to make the pain stop. And almost every single time in market history, the people who panic sold during a downturn would have recovered. And then some, if they had simply done nothing. This leads us to the second major mistake: trying to time the market. Nearly every new investor believes they can predict the top and the bottom. They think, I'll wait for the price to drop further before I buy, or I'll sell now and buy back in cheaper later. But here's the uncomfortable truth. Even professional fund managers, people who study markets for a living, with teams of analysts and access to information you and I will never have, fail to consistently time the market. If they can't do it reliably, the odds of an individual doing it successfully again and again are close to zero. The data consistently shows that missing just the 10 or 20 best trading days over a decade, days that are impossible to predict in advance, can cut your total returns by more than half. Time in the market almost always beats timing the market. The third mistake is overtrading. Some people don't lose money because they picked bad investments. They lose money because they touched their investments too much. Every time you buy and sell, you're not just taking a risk. You're also paying in fees, in taxes, and in the mental energy of constantly checking your portfolio. Studies on investor behavior have found something fascinating. The more frequently someone trades, the worse their average returns tend to be. Meanwhile, some of the best performing accounts in history belong to people who forgot they even had the account, or in some documented cases, people who had passed away and their portfolios simply sat untouched for years. There's a lesson buried in that irony. Doing less is often more profitable than doing more. The fourth mistake is chasing hype instead of understanding value. People buy stocks because a friend mentioned it, because it's trending on social media, because a headline promised the next big thing. They don't ask what the company actually does, how it makes money, whether it's overvalued, or what could go wrong. They're not investing. They're gambling with extra steps. and gambling dressed up in financial language still behaves like gambling. The companies that quietly compound in value over 10 or 20 years rarely make exciting headlines along the way. Real wealth building is often boring, and most people don't have the patience for boring. The fifth mistake, and this one is subtle, is a complete lack of a plan. Ask most people why they bought a particular stock, and you'll get a vague answer. Ask them what their exit strategy is, or how this fits into their broader financial goals, and you'll often get silence. Without a plan, every decision becomes emotional and reactive instead of intentional. You end up buying on hype and selling on fear, which is precisely the opposite of what actually builds wealth. Professional investors, the ones who consistently succeed over decades, treat investing like a system with rules. They decide in advance how much they're willing to risk, what would make them sell, and what their long-term goal actually is. And then they follow that system, even when emotions are screaming at them to do otherwise. The sixth mistake is underestimating the cost of fees and inflation. A small percentage in fees might look meaningless on a single trade, but compounded over 20 or 30 years, high fees can quietly eat away a significant portion of your total returns. On top of that, inflation is constantly working against you in the background. Money sitting still or growing too slowly is actually losing purchasing power every single year. People don't lose money only through bad decisions. Sometimes they lose it simply by not accounting for these silent, invisible forces working against them the entire time. Now here's the part most people never talk about. The psychological trap that ties all of this together. Overconfidence after a win. When someone makes a lucky trade and gets a big return, their brain doesn't register it as luck. It registers it as skill. This is one of the most dangerous moments in an investor's journey, because it's usually followed by bigger bets, more risk, and less caution, right before the market humbles them completely. The investors who survive and grow their wealth over decades are the ones who stay humble even when they're winning, because they understand that markets are unpredictable in the short term, no matter how confident anyone feels in the moment. There's one more layer to this that rarely gets discussed, and it's the comparison trap. In the age of social media, it feels like everyone around you is getting rich overnight. Someone posts a screenshot of a trade that doubled in a week. A stranger online claims they turned $1,000 into $100,000. What you don't see is the thousands of people who tried the exact same thing and lost everything, quietly with no screenshot to show for it. Survivorship bias makes the stock market look far easier and far more glamorous than it actually is. And when people compare their slow, steady, boring progress to someone else's highlight reel, they start taking risks they never would have taken on their own, just to catch up to an illusion. The truth is, you are not actually competing with anyone. Your only real competition is your own patience. So if losing money in the stock market isn't really about bad luck, or about not being smart enough, or not having enough money to start with, what actually separates the people who build wealth from the people who don't? It comes down to a few simple, almost boring principles. Invest consistently, regardless of what the news is saying that day. Diversify, so no single mistake can wipe you out. Think in years and decades, not days and weeks. Control your emotions instead of letting them control your trades. And understand what you're actually buying before you buy it. None of that is exciting, none of that will make headlines. But it's exactly why the people who actually build wealth in the stock market are rarely the loudest voices online, and almost never the ones chasing the next big trending stock. They're the quiet, consistent, patient investors who understood something early on that most people never do. The stock market doesn't reward the smartest people, it rewards the most disciplined ones.